I'm of the opinion that the world has changed. Many of us are looking for some kind of mean reversion back to the way it was, whether that's prior to the financial crisis, whether that's to the heydays of the 90s, or perhaps to the sort of the 1980s. It's not going to happen. I think the world has changed. It's taken me a long time to get to this position. I was very skeptical of that position, but I want to try and explain why I think this way in the next 25 minutes. So part of it's a conditionality problem, and here's what I mean by this. If you look at the VIX volatility index in 2007, July 2007, it reaches its all-time low. You could have got options for peanuts on nothing happening for the next 5 years, and then the world blew up. If you have a look at central bank policy, central banks spent the whole of the 1990s talking about credibility and how whatever we do, we must be very careful with the public's money, and we shouldn't go throwing it around. And ever since 2008, all they've done is throw it around. If you'd actually wondered that, Europe, that place that's filled with socialists and social democrats, might actually react the same way, who knew that they would actually follow the German lead and basically go for austerity on steroids for 10 years, thereby dragging the whole continent into a giant slump? And then think about the UK voting to leave the EU. Now, here's a weird one I want to talk about. Inflation. That's a $100 trillion note from Zimbabwe. The only countries that suffer hyperinflation, and this is really true, are countries that have decided to do it. So even the sort of wonderful image of the Germans with a wheelbarrow full of money, that was actually done to screw the French over reparations. Right, so this doesn't happen just because people throw money into the money supply. It's deliberate government policy to get that way. And we live in a very interesting world where, depending on how you count it, about $13 trillion have been pumped into the global economy by central banks. And there's no inflation anywhere unless you're already Zimbabwe, an economic basket case. Oh, and this guy might be the next president. We'll get back to Trump later. Now, who saw any of that coming? You would have got very long odds on any one of those things happening. But if you think of this as a conditional probability problem, wow, what's the odds of that times the odds of that when you don't know the value of that compounding with that? That gets very complex very, very quickly. And there's a temptation for us, all of us, in our lives professionally and also personally, to focus on the moment, to focus on the thing that comes up now, whether it's Brexit, whether it's the Greek crisis, whether it's the latest payroll data from the United States. But let's try and get away from the present. Let's think about the longer term here and see if we can tell a common story about why the world might have changed. So here's the first question. Does history repeat? So I told you Trump would be coming back. There's a whole website out there that actually does Trumpiscone for Berlusconi, and then there's also the Mussolini ones as well. He makes exactly the same hand gestures, which is very, very strange. Anyway, many people do think that we're going back to the 1930s and then to the 1940s. And you can understand why. Well, first of all, in the 1920s, you had a series of financial crises. Those financial crises led to deep recessions. Those recessions then led to the collapse of democracies, particularly in interwar Europe, and then there was the turn to authoritarianism, if not fascism. Are we going down the same road? Well, actually, I think not. And prizes for anybody who's actually ever figured out that Søren Kierkegaard, the Danish philosopher. And it's another conditionality problem. You don't get to replicate the past. The very fact that you've lived the past means that that past simply can't come up. That's Kierkegaard's point. He basically says that the world is always a world of becoming, and that you live it forward into an unknown. So if the world is essentially unknown, and you've already exhausted the conditions of the past, you can't really go back. It doesn't work like that. It's a convenient way of thinking, right? We fall into that as humans. We like to see patterns when there are none. But the world's actually much more random. Now, if that's the case, is it all random? No. Let's think about regimes. Now, what are regimes? Well, on the left-hand side, you can see something that I religiously follow as a dietary regime, as you can see by my ballerina-like figure. When we think about regimes, we tend to think about political regimes. There's Gaddafi. There's Gaddafi as the eponymous regime for that one. There's 22,000 quid for Kate's beauty regime, which, I think is a little bit excessive for someone of her age, but what do I know about makeup? There's a skincare regime, but obviously I'm actually talking about something else. So economists typically talk about markets and states. the two sort of things. One of them's a hierarchy, one of them's a level playing field, ideally. And when you think that way, when you bifurcate it in that way, there's a tendency amongst many of my colleagues to see politics as kind of the error term in the equation. It's something that gets in the way of otherwise well-functioning markets. And quite a different way is to think about complexes of countries as complexes of regimes. Now, here's an example of this. How many of you have got a BMW? Anybody here drive a BMW? There's nobody in the whole room. Good for you, right? It's a good car, right? It's a very good car. How many of you think the Americans could produce a BMW? No chance. It's not going to. Trust me, I live there. No, right. Now, how many of you got an iPhone? Right. How many of you think that the Germans could produce an iPhone? I want to short your paper. Here's why. If you look at patents or patents, I can never figure out which way you say it in which English-speaking country, the Americans and the Germans have exactly mirror opposite patents. What the Germans do is incremental innovation. They take one thing and they make it just a little bit better every year. And when you do that over a 20-year period, you end up making a BMW. And the idea that Buick is going to make that is rather far-fetched. On the other hand, there's no way that the Germans do what Apple does, which is to take 6 pieces of technology, 5 of which were lying around invented by the Defense Department, stick it in a shiny case and make the whole world go, ooh. Radical innovation. Now, filter that out and then think about skill formation. How do the Americans do that? They leave it to the market. They do a lot of it through educational institutions. How do the Germans do it? They do it through unions. They do it through apprenticeships. You know that 50% of German firms have no stock market listing, whereas American firms use the stock market not for basically raising capital, but to buy back their own shares and boost their internal returns. And you begin to see that there are these patterns, these clusters of how people do things, and they hang together in certain ways. Now think of that as the hardware. Now think about the software that goes with it. So if economies are different complexes of institutions, how you do skills, how you do retirement, how you do governance, how you do infrastructure, all these things, the rules as to how you do that, what's it all for? The software, that can be programmed in different ways. So what produced our current macroeconomic regime, by which I mean the modal type of the Western world, the developed world just now? To do that, you have to go back to 1943. So at the height of the war, Keynes is running the show in the British Treasury, and there's a great line that you've all heard a bit of, and here's the full line. The long run is a misleading guide to current affairs. In the long run, we are all dead. That's the bit you've heard. Economists set themselves too easy, too useless a task if in tempestuous seasons they can only tell us when the storm is long past that the ocean will be flat. Now, why was Keynes concerned about the short term? He's concerned about the short term because the way that he thought about the economics, it's not about the government spending money. That's what it's become down the line. It was about investors' expectations. So if your investment expectations in the short run is that I shouldn't invest because we're in the middle of a recession, you will not invest. And when you watch her, you will not invest. And when you watch them, you will not invest. So everyone's short-term expectation compounds and becomes the long-term. So you have to change the expectation baseline. That's why you boost consumption. That's why you do all those things. Now, in the right-hand panel there was a piece written in 1943 by an émigré economist from Poland called Mikhail Kalecki, or Kalecki, depending on how you want to pronounce it. And I encourage you to get this. It's 7 pages long. There's no math. It's in plain English. It's incredibly easy to find on the internet. And it's called Political Aspects of Full Employment. And what Keynes said the central problem of the Great Depression was millions of unemployed with no safety net. And the result of that was desperation, poverty, and more importantly, authoritarianism, fascism, communism, things that will destroy capitalism. So the whole goal of full employment was a political goal. What Kalecki pointed out was if you run full employment as a regime for 30 years, there's going to be a problem. So what would the problem be? Have a look at the top panel, 1979, Britain, the winter of discontent. The unions bringing the country to a standstill. The bottom panel is Gough Whitlam in 1973, the same problem of stagflation. You see, if you run full employment for a very long time, ultimately you end up with very tight labour markets. And if you have national, relatively closed economies where capital can't get out and move around, the only thing that can happen for business to retain profits is to push up prices. But that's a nominal trick. And after you push it up a few times, wages are bound to catch up, and suddenly you get caught in an inflationary spiral. Business has to find a way out, because otherwise there's inflation, a collapse in investment, and a collapse in profitability. Kalecki predicted this by page 3 of that 1943 piece. Page 4 gets even better. He says, what's business going to do in such a world? He said it would fund a market-friendly political revolution. They would discipline organized labor by weakening the power of trade unions. They would deregulate finance to increase capital mobility so that if labor went on strike, it wouldn't matter. And if you have a look at the incidence of strikes across the developed world since 1979, it goes from high to not very high to basically non-existent. You will also hand over policy to technocrats. You don't want parliaments running those things. That's where labor has a voice. And you will above all globalize production, because that way capital has the whip hand. He honestly wrote all this down. It's amazing. He's got a time machine. It's the only explanation. Now, let's think about this in terms of regimes. What does that world of the 1970s look like, the house that Keynes built? Sustained inflation. Labour share of national incomes at an all-time high. Corporate profits were at an all-time low. Unions were strong. Inequality was low. You had national, relatively closed markets. Weak finance. Central banks were just check-cashing agencies for the Treasury. And parliaments wrote the rules. Where are we now? We're in a world in which systemic deflation rather than inflation seems to be the rule of the day. Despite all that money from the central banks being chucked into the financial system globally, there just isn't any unless governments are trying to actively promote it. And even when they are, they can't hit their inflation targets to save their lives. Capital share of income's at an all-time high. The wage share is at an all-time low. Unions are weak everywhere. Inequality is high. Markets have been globalized. We've built the exact opposite regime. It's almost as if the Reagan and Thatcher revolutions have, just like the Keynesian revolution before them, become too successful. Right? Keynes had within him the seeds of his own destruction, and that's what Kalecki called out. Are we at that point now with the house that we've built over the past 25 to 30 years? So what's the problem with the current regime? There's 3 of them. Here's the first one. We live in democracies. That's a problem. It's a problem in the following sense. Who wins and who loses if you basically have a sustained deflation? That is to say, you have systemic disinflation, and it's very hard to get up to a 2% inflation target. Well, creditors lose. And that's a problem because, as you know, there's a hell of a lot of credit in the system, both public and private. And they lose in the following sense. In a deflation, the value of debt goes up, but the ability to collect it goes down because people don't have wage growth. There's no real growth in the economy to boost their ability to pay back the debt. This creates a real problem, particularly in politics, for center-left parties. And if you look across the developed world, what you find is the Democrats, New Labour, New Democrats, that's gone. The Social Democrats in Germany, they won one Eastern lander last week, or this week, in fact, last week. But prior to that, they got 19% in the last round of elections. The Swedish Social Democrats used to be able to take a dead Labrador, put a red rosette on it, stick it on a street corner and soda them, and you'd get a 50,000 majority. Those guys now have to govern in coalition with a bunch of right-wing loonies. So the world's changed for those guys. Why? Why those guys? Because they were the ones that supposedly were protecting the people at the bottom end of the income distribution, who were the ones that were going to get the really bad end of everything that was about to happen. We sold them a nice little dream on globalization. This is what Trump's picking up on. Go to a place like Gary, Indiana. Go to the American Midwest. The anger that people are talking about is this. Now, go to the other side of this. Who wins in this one? Well, it's those guys in a sense, because debtors can't pay, won't pay, will vote. And what's the other side of the politics? It's the collapse of the center-left, but it's the rise of the new right. This is why the National Front in France is polling 30%, ahead of both the other parties. This is where Trump comes from. This is Brexit. This is the anti-immigration pulse, all of it. It's another form of protectionism. Second problem, Branko Milanovic's not-so-happy globalization story. So along the bottom here, you've got the entire global income distribution from 0 to 100, the poorest person in the world to the richest person in the world. And what you've got on the y-axis there is the amount of income growth you've had over 30 years. Tells a really interesting story. Countries like Chad are poor and will stay poor. But once you get past Chad, there's been very rapid income growth. And the best example of this, as Australia knows all too well, are the people that have been buying all your dirt for the past 25 years, namely China. So to go from a country where you had 400 million people below the World Bank's $2 a day poverty level to an average income of 6,600 per capita, that's incredible. We've never seen anything like that in human history. So for some people, this has been utterly brilliant. It really has been the best of times. But notice where that graph begins to go down. It starts to do that at the 67th percentile. Guess who that is? That's the poorest person in the United States. So there, the income growth slows, stalls, and it doesn't start coming back up until you get to, guess what? Basically the top 10%. And as you can see, you get to the Thomas Piketty story, the famous 1%, and they're the other people that have been doing really well. Now here's the problem. Which bit of the world votes in democracies? The bit on the downslope. Next one, Thomas Piketty. I had to put that picture on because I know Thomas, he's a nice guy, but why would you let yourself be taken like this? I mean, what's he say? Like, there's no blood on my hand. The glove doesn't fit. I mean, I'm not entirely sure what he's doing with that. He looks positively bonkers. It's a great book. Nobody's ever read it. It's funny, if you actually get the Kindle thing, whereby they track the number of pages that people go through before they stop reading, apparently the entire world has read the first 8 pages of his book. And there's nothing else, so it's a bit of a shame. Chapter 2 is the bit you need to read. But anyway, what's the story? So here's this R versus G, or R is greater than G. The rate of growth in returns on capital outpaces the rate of growth in the economy over the long run. Very simple way of thinking about this. I own a condo in Boston. That thing's going up at 6% a year, in part because of Chinese capital flight. This is happening all over the world. What's the underlying rate of growth of the US economy? 2%. So I'm making 6 real on a 2% baseline. That's R versus G. It's really that simple. There's nothing too complex about it. But what it does create, if we go back to that slide, is exactly that line that goes up at the top. It creates what Thomas calls a winner-takes-all economy, where returns float at the top and growth stalls. And an example of that, since the financial crisis, 90% of income gains have gone to the top 1%. And since 2012, 70% of that 90% has gone to the top 0.1. The problem is they don't buy that many fridges or other mass consumption goods, so it doesn't filter down. Now, with all of that, what's a pension investor going to do in such a world? Because what I'm suggesting, just to bring this home in case it isn't clear already, that some kind of mean reversion where we get back to doing what we're doing before, it's just not there. A very simple way of thinking about what we've been living through for the past 30 years is a period of inflation and therefore a period of interest rates which have been abnormally high. And what we did was we rode that all the way down, taking leverage on to make money on a declining spread, until basically all of the institutions of the financial sector globally became massively fragile and massively over-levered. There was an accident waiting to happen. It happened in 2007, 2008. Now, you can talk about reversal in the bond market, etc., but it's not as if it's going to turn like it did in '94 or even before that, because we're not going to go back up to high inflation. All right? Very simple way of thinking about this. Right now, 2 parts of the 3 parts of the world economy, that is to say Asia and Europe, are running a surplus against the 1 part of the world that's still not running a surplus, which is the United States. Now, with that much saving going on across the world and a lack of demand in those areas to absorb it, that capital has to be exported. And what's that going to lead to in terms of a global interest rate? It's going to decline. So the story that you're hearing now about the long-run rate of interest falling is true. And if that's the case, think about bonds. What is it, 13 trillion in negative yields globally or something absurd like this? Now, if you've got negative yield and substitutable assets all the way out the long end of the curve, we all get excited about what the Fed does. Oh, the Fed's going to raise rates by a quarter. It doesn't matter, right? It doesn't matter what you do in the front end of the curve. You've basically got substitutes or negative yielding all the way along end. So you've got very low inflation, very low structural interest rates. That's a very different world. And you've also generated the potential, as we're beginning to see, for a very nasty politics. How do we play this? The problem's a lot more than making 3% real when rates are at 1%. So the first thing is, let's think about politics. What is politics? Politics is volatility. Politics are unexpected shocks that people are going to get freaked out by. I used to go on Bloomberg until I said the following and they didn't invite me back. So, Mark, just before we start talking about the Greek crisis, Give us your thoughts. Today, the Dow's down by 3%. Yesterday, it's up by 3%. What's going on? My answer, a bunch of people bought stuff, a bunch of people sold stuff. What are you talking about? Why do we need to find some kind of big narrative in everything, right? Said the guy giving you a big narrative, all right? There's no contradiction, trust me. Volatility is going to happen. You can hedge against it, you can trade it. I'm not suggesting that all pension funds become basically day-to-day hedge fund managers and you become option traders. But you know that certain things are going to come up. And let's take an example with, for example, Trump, right? Trump's going to put 35% tariffs on companies exporting from China to the US. Yeah, good luck with that, considering one of them is going to be Apple. Most of the companies that are exporting to the US happen to be American companies, so that's clearly not going to work. But the volatility will be there. Think about Brexit. What's actually changed? Nothing. But there was definitely a large trading opportunity when everyone basically pooped themselves the first couple of days, only to figure out nothing had actually happened. Second one, if we know the world's going to be long and low for an extended period of time, despite that higher underlying volatility, what does it mean? Well, if you're in Europe, for example, the Germans have forced everybody to write a series of fiscal treaties which make no macroeconomic sense whatsoever. The fiscal compact, the two-pack, the six-pack, all this sort of stuff, right? Sounds like a bunch of rappers, the two-pack and the six-pack, but it's actually a bunch of mindless fiscal constraints. So fiscal policy is dead. Now, the rest of the world is going to wake up to the fact that, oh yeah, we have this fiscal arm, we should use it, particularly because with central banks basically guaranteeing the debt stock of all the advanced countries, they have no liquidity constraint, remember? Ultimately, you don't really have to worry about those assets. So if that's the case, fiscal policy is going to come back. In the countries where it doesn't, you're going to rely even more on monetary policy. But you've done everything. We've done QE. Happy to talk about it in the Q&A. QE, here's my analogy for QE for what it's worth. You want to put the kettle on, right? So what you do is you get a high-pressure fire hose and you stick it through the front door letterbox. And then you turn it on and you hope some of it ends up in the kettle, right? That's pretty much QE, right? That's it, right? So what's going to happen is something much more targeted called a helicopter drop. We're going to basically target the bottom 80% of the income distribution, and we're going to give them checks. Now, it's going to upset a lot of people, but it's a hell of a lot more efficient than pissing water through the fire hose trying to fill up the kettle, which is what we've been doing with QE. It's also going to be very popular with debtors. Remember that politics story I was telling you? Because they're going to be able to clean up their balance sheets. They're going to be able to get out of payday lenders. Any politician that does this is going to win big time. So it's just a question of time until they do it. Now, the good news is, it's not all bad news. The guy on the right, obviously, is Larry Summers, otherwise known as a Sith Lord. And the guy on... shh, you can hear everything. The guy on the left is Alvin Hansen. He's the guy who coined the term secular stagnation. The belief that basically, due to a combination of demography, excess savings, etc., the world's potential rate of growth is structurally fallen. It might have. I'm sympathetic to some part of that. But if you think about it, there's a different way of telling the same thing. Now, is there going to be a new financial crisis? I don't think so. Here's why. For those of you who work in trading desks or anything like that, here's your world before the financial crisis. I'm going to do whatever I want, and I'm going to find some idiot in the compliance department to fill in the forms. Here's what happens now. I'd like to make this trade. 7 people in the compliance department say no. Right? So the entire structure of the industry is basically being beaten down. This is policy, folks. It's not an accident. It's called delevering and de-risking the system. Commodity shocks. The only commodity shocks we're getting, which you guys in Australia know about, is they're going down. The notion of a giant big commodity shock hauling problems, I just don't see it anywhere soon. And political shocks, that volatility I was talking about, yeah, it'll be GDP positive, because either it's going to be helicopters, or alternatively it's going to be infrastructure, and lots of it. So you can position yourself to take advantage of that. What you end up with is a world that's long and low with positive growth going forward, a bit like the 50s rebased. So rather than having inflation at 2, interest rates at 3, and growth at 3, imagine a world in which inflation is basically 0, interest rates are 0 to negative, and you've got 2%. That's a spread you can live with. It's going to kill banks, but as I said, that's part of the idea. That's policy. They just don't want to admit it in public. Is this going to be enough to guarantee pension pots? Demography is a big problem for you guys as well as slow growth. But if real growth is still high enough to do some things and you're clever about it and well positioned, you can survive. My personal tip is think about the boomers. Baby boomers are the only people in human history, the only generation in human history that has increased their consumption through the life cycle. Right? And they already consume 17% of US GDP in healthcare, and it's going to head to 20% before they're all dead. So basically, buy big pharma and healthcare in the US, and you're going to be fine for the next 20 years. Second one, switch from demographically challenged to demographically active portfolios. What do I mean by this? We're running out of a couple of things. We're running out of teenagers. Right? The bump for them is going. The other one is we're running out of dentists who are anarchists on the weekend, by which I mean Harley-Davidson riders. So if you start to think about firms which are demographically challenged and you swap them out for ones that are not, you'll be surprised how much you outperform the S&P. And then the last one, buy real assets and infrastructure. But for God's sake, avoid Europe, because they've set themselves up with the euro into some kind of fiscal dungeon with a one-size-fits-none currency, with a one-size-fits-none exchange rate policy, which is in particular causing huge strains in France and even bigger strains in Italy. The Italian banking crisis isn't a banking crisis, it's really a euro crisis. But the problem with the euro is it's a bit like the Hotel California. You can check in, but there's absolutely no way to check out. So I hope you found those provocations interesting. I hope you've got something there to chew on, and I look forward to your questions. Thank you.
Thanks, Mark. Now, I made a mistake earlier on. I should have advised you that the AXA IM Live Q&A is now open and will be for the rest of the duration of the session. And please follow the instructions on the screen. And while you're formulating your questions, there's a number of questions I have for Mark, but as they come up, no, we'll start with one that's already on the screen.
Exactly, that's a good one.
Do you believe in the concept of the presidential cycle driving risk asset returns according to the stage of the 4-year presidential term?
No. And because basically politics is predictable, but it's not as predictable as that the theory behind that says it is, which basically says that politicians come in and then they pretend to be all fiscally responsible, so you can price that in, and then they know an election's coming up, so they're going to spend, and that's when you get inflationary pressures and you can map it out as a cycle. That's the basic theory behind all of those other theories. And that implies a degree of control that politicians would have that they simply don't. So I just don't think that it tracks well onto that. I think it's like what people would like to do, but I don't think it really pays off. Does world debt ever need to be repaid? Brilliant question. There's a fantastic paper by Silvio Ostri from the IMF that came out about a year ago. Big paper, big research paper, big IMF stamp on it, very senior economist, lots of technical stuff in it, and it basically says, let's pretend it's not there. That's basically it. Because the alternatives are really, really painful. Right? So they've been trying to do it in Europe through fiscal austerity, and it's been going really well. Let's think about Spain, right? Spain's the success story. 20% unemployment, a 5% deficit, and 100% debt to GDP. Knock yourself out. That's going to go really well, right? So essentially, the solutions are kind of what the Brits did after the Napoleonic War, consoles. You basically do a 100-year bond, you drop the cushion, and you hope you get some inflation. That's it. Boom. That's what we're going to do with it. You want to do these? These are great. I'm happy to go with these.
I might have one.
All right, you're in next, right? Helicopter money can't be a free lunch. What's the risk? It's not that it's a free lunch. I think it's a better, honestly, all right, so here's the thing. This is the quantitative easing point, right? If the whole point is to hit an inflation target, if the long-run rate of interest, the long-run rate of inflation is falling, then there's an argument for pushing the inflation target higher. So you actually want inflation in the system. Now, if you accept that hyperinflations don't just happen because things snowball and they blow up, right? They really become, it's the government policy that does it. Then you're effectively able to hit your inflation target with a helicopter drop much easier, faster, and cheaper than using the giant fire hose. So is it a free lunch? No, but neither is QE. Not just in terms of distortion. We have this in our head that somehow fiscal policy is redistributive, but central bank policy isn't. Well, a very simple one is interest rates are redistributive. If you put up rates, you're rewarding savers. If you're pushing them down, you're doing the opposite. So it's just a question of how you're redistributing. So there's no free lunches. It's just a question of who pays the bill for lunch.
I'll get my one or two, and I'll have 3 parts. That's the way to do it.
Oh, go on then.
Firstly, in your book on austerity, bad idea, you actually raised something I hadn't fully realised before, was actually a policy difference in policy responses. Whereas the Federal Reserve was very Keynesian, the ECB I mean, very much austerity. And I was flabbergasted with the Greek situation. If they could have bought all the Greek debt out for 50 billion at the beginning, but now we're further down the track, and if you may enunciate on that. But also, did you expect this post-GFC period to be as long as it was? And have the responses by the policy, by the respective central banks, actually unwittingly capped the level of interest rates going forward? So we are truly in a very, very different environment.
Let's take the last bit first. I don't think central banks really have that much of an effect on interest rates, and I already alluded to why. I think interest rates in a globalized economy are set by the global economy. And if you have two parts of the world, Europe and Asia, effectively over-saving, then central banks doing what they're doing are certainly pushing in the same direction, but I don't think they're capping it. I actually think if you actually stopped it tomorrow, you're not going to jump back to 10%. That just simply isn't going to happen. In terms of the first one, the reason that I have ended up saying that we may be changing, and I've reached back and tried to make sense of Kalecki and what it looks like if you turn this upside down and all the things I just went through, is precisely because it's gone on an awful long time. So, you know, are we going to do this again? Are we going to be sitting here in 10 years' time going, when's the new normal coming, right? Because you've just lived through, it's nearly 10 years. It's nearly 10 years since this whole thing kicked off. So to me, I was surprised about how long it was taking. I wasn't surprised by the policy responses. It was quite predictable what was going to happen. And I predicted them in the book. Go check it out. But it has made me think that where we are now is actually crossing a threshold. We're going into a new space. Shall I go with these?
Yeah, go with that.
All right. Let's get to the fun one. Who thinks Trump's going to win? Give me a show of hands. Who thinks that there is a greater than 60% possibility Trump will win? Here's my little narrative on why. I mentioned Gary, Indiana. Gary, Indiana used to be a very prosperous city like Detroit. And here's a story I tell about Gary. I did it on NPR radio in the US just before I came over. So imagine a guy called Gary who lived in Gary, Indiana. And Gary used to work in the union job in one of the big car plants. And it's 1991, he was earning $30 an hour. That's really what he was earning in 2016 dollars, so it was a lot. And they shut it down, and they moved it abroad. And bits went to Mexico, and some other bits went elsewhere, and all that sort of stuff. So he was meant to retrain. He was meant to retrain as a software engineer, but there was no money for retraining because we gave it all away in tax cuts, because that's what politicians like to do. So he then got a job in a call center. He was fine, he adapted, but he's down to $15 an hour. 5 years later, the call center goes from Indiana to India. He now works for the largest employer in the United States, which is Walmart. He gets $11 an hour. And every day he reads in the newspaper that him and all his mates are about to be replaced by robots. Wall Street's delighted. They got bailed out. He lives in a slum. He's pissed. That's Trump's support. That's an incredibly powerful self-understanding and self-narrative. Now tell me what Clinton's narrative is. There isn't one. There isn't one. That's why Trump cannot be discounted. All of the gaffes, all of the racism, all the incendiary comments, it's not just feeding to the base. It's bouncing off him for a reason, because he deep down has one really powerful narrative and a really connected core constituency. And that type of thing hasn't happened in American politics in a generation. So I give him 60% probability. Clinton's negatives are also horrible. No mainstream. If you take Trump out and you look at her negative ratings on their own versus any other candidate, it's amazing. So there's a double hurdle for her to overcome in that regard. You want to get back in, Michael?
I'll ask a few more
go
questions.
With us? All right. Buy real assets. Do you have an opinion on Australian house prices? I've been saying that you guys have been in a bubble since 2004. So that's the oldest broken record of all time. All right, so what's the definition of a bubble? I'll tell you something interesting about this, right? Not just Australian house prices, global ones. In 2011, there was a survey done by the Chinese government which was suppressed, like many of their surveys. And this one was snuck out the back door by someone. And it said that if you had 1.5 million US in assets, there was already a 15% chance you were living abroad. If you had 15 million in assets, there was a 23% chance you were living abroad, and a 50% chance that at least one member of your family was abroad. 30% of the intake of Boston University's freshman class last year was mainland Chinese. And you all know about all those condos that are being built all around the world. Vancouver was just the leading edge of the spear. Now, when you have that much capital flowing out into assets in other countries, even if they're effectively dead assets, like real estate I'm not going to use, that's an incredible support for the floor of a local real estate market. So even if the good times in terms of commodity exports have ended for Australia and there'll be a period of adjustment, you actually have something even more valuable to offer exactly the same people. Rule of law and asset security, something that they actually can't find at home. So if the definition of a bubble is the income streams cannot support the asset values, what happens if there are hidden income streams we're not actually factoring into this? And I think a very large part of that is going on in terms of the high to middle end of global cities and the housing markets in them.
You did raise in your talk, Mark, there was little chance of a new financial crisis. Why?
Well, partly the regulatory culture has completely changed, but partly because nobody wants to, all right, here's why nobody wants to admit it. Imagine that I'm Jamie Dimon, right? So I run a big, big bank in America. And I'm not Jamie Dimon. You can be Jamie Dimon, right? And I'm a crusading anti-bankster. I'm sort of Elizabeth Warren on crack, right? So I'm going to take you on. I'm going to shut you down. I'm going to make you de-lever. I'm going to do this. You're going to have a tiny asset footprint. I'm going to reduce the system, right? Well, you know, not just Jamie. I mean, any major Wall Street titan could take a huge amount of money out of their back pocket and effectively lobby in such a way that my next job is dog catcher of Arkansas. So politicians are smart enough to know one thing: safety in numbers. So there's a reason that there's no Glass-Steagall this time around. There's Dodd-Frank. Now, why is Dodd-Frank 2,200 pages long? Because it's death by 2,200 cuts. I'm going to escrow your bonuses. I'm going to raise your compliance costs. I'm going to make sure that you're going to build the biggest risk protection department, which are mainly useless, than you've ever seen in your life. I'm going to make sure that it's very hard for you to trade in certain areas. And I'm going to de-lever and de-risk the entire system over a 10 to 15-year period. Then we're going to have the fintech disruption that's going to go on top of that, that's going to disintermediate the sector at the same time. So nobody will say this publicly, but that's pretty much the game. And if you actually look at the leverage ratios, not just of American banks, their daily operating leverage, but European banks, that's the really big one. They're in an environment where they can't make any money, the economy isn't growing, their assets aren't doing anything for them, and their leverage ratios are just falling and falling and falling. They're getting much smaller. They're de-risking the system. So if that's the story that's going on globally, that's why I just don't see that being a problem.
Right, back to some of the audience questions. Do you think pension funds can start to fill the space of banks by creating and utilising their balance sheet without the same constraints as banks?
I think that it's already happening. And it's not just pension funds, it's everyone. So I'll give you an example of this. Harvard University's endowment. So Harvard University's endowment, if I remember correctly, at its height was something like 57 billion. So you could have got a seat in the UN and would have been one of the sort of 40th biggest countries or something just by being Harvard. So huge amount of money. They lost a third of it, but then they make some of it back. What's their new plan? Buy real stuff. Right? They actually want to become asset managers in the sense of owning real things. What else do they want to do? They want to run the full suite of alternatives. The notion that they're just basically going to buy a bunch of bonds and then balance this with the equities and do some maturity matching, etc., done. They're looking for a completely new way of investing the money going forward. And I think what's going to happen is, despite the regulatory relationships and the, what's the word I'm looking for, the regulations regarding what pension funds can and cannot do, over time this is going to change, and it's going to have to change, because the world is long and low, because people are getting older, and the idea that politicians are actually going to explain to the public that they're going to have to do with less, good luck with that one. That's why you're going to get helicopter drops, amongst other things. So on the way over here, I was reading a piece by UBS Research, and they were talking about the world going forward and all this sort of stuff, and they were talking about pensions. And their argument was the best thing we could do is governments are going to have to explain to their populations that they're just going to have to do with less. How many of you think that's even remotely plausible? Right. It's just never going to happen. So if that's the case, are you going to become more like alternative asset managers in general? Yeah, you're going to have to. And the politicians are going to give you the regulatory freedom to do it. It's just a question of time.
What retirement pot might we really need to aim for in a disinflationary future?
That's one I would throw back. The question was, what retirement pot might we really need to aim for a disinflationary future? So the simple one is, okay, what do you guys really need? Do you need 3% rule? Is that it? Is that what you need to balance it? Is it 4%? You can probably get that if at the end of the day it's 0 and growth is at 2%. It's not that much of a leg up. But the question is, what does the world look like that you're saving for? So if it's the United States, and the United States is an unreformable healthcare system, and they really are going to spend 20% of GDP on it, that's dangerous. That's unsustainable. If you have a relatively sensible healthcare system that costs 7% of GDP, you can manage that on that basis. It depends on what the expectations are, both of the people who are the recipient of the funds, and then those who have to generate the balances to make it work. Tell you the worst job in the world, could you imagine being a state pension fund manager for the public sector in the United States? Forget it, you're already bankrupt. The only way is down. So what you have to do is manage the expectations of a system that itself is much more sustainable than, for example, the American one. It's a challenge, but I don't think it's as big a challenge as people are making out. Great question here. Greatest threat to global stability, Le Pen, Brexit, or the Donald? The Donald, and only randomly. Right? I don't think he, so again, I'll tell you something shocking, right? So the only person in human history recently who's actually advocated and tried to deport 11 million people was Joseph Stalin, right? And the Donald has says he's going to do this, right? Now, here's the weird thing about it. How many people has Obama deported in 8 years? Have a guess. 3 million. He's done that. The great liberal. Interesting, isn't it? So maybe Donald gets it 3, maybe Donald gets it 5. But if Obama's done 3 and he goes to 5, is that a revolutionary change? Is he really going to stick 35% tariffs on? No, I don't think so. Could he get us into a war with Putin because Putin takes the piss out of him and he doesn't like it? Yes, that's what worries me about the Donald. Now, the Brexit one, we're going to do we have a master class later. I'm hosting a master class. What am I, a Jedi, right? But, you know, if you want to come along, we can talk about Brexit, right? But the short version on Brexit is it doesn't matter, and I'll be happy to explain why.
Right.
Hold up. Well, bollocks at Trump's I'm glad somebody finally used a good word. Bollocks that Trump's resonance with voters hasn't happened in a generation. What about Obama, Reagan, even Bill Clinton? Thoughts? Right, fair point. Obama's coalition of hope, right? What exactly was that? I mean, was that a real social movement? Yeah, it was. And who was it? It was basically sort of 20-somethings and liberals and people who live in the urban centers. Absolutely. In the same way that Occupy Wall Street was a version of that. It's ephemeral. It operates by social media. It's a media creation. Was there something behind Clinton other than the charisma of the guy himself? I'm not entirely sure that there was. I really do believe that what Donald Trump has not created but tapped into is basically 20 years of people who feel that they've had their voice taken away. Now let's go back to Brexit for a minute. My favourite little bit of this. Which city in the United Kingdom voted the highest for Brexit? Sunderland. 61% at Sunderland. Now, where does Nissan make all of its cars in Britain that it sells to Europe? Sunderland. Now, that's about as economically rational as sticking a fish in your head. That's what they did, right? Now, why did they do that? Because this is visceral. This is about, you've just given me an opportunity to tell everybody who runs this place that I really hate your guts. That's what they're tapping into. That's why this is very, in my opinion, much more powerful than we think. It shouldn't be discounted. Do I miss playing in a band? No. The last time I lugged this bass amp up a flight of stairs, it dropped on my foot and I swore blind I would never do it again. Is there a sensible wealth distribution mechanism to maintain social cohesion? Yes, there is. It's called paying your taxes. Apple, take note. It's that simple. You're not allowed to use graphs here, right? So otherwise I would have shown you lots of them. Because a picture paints 1,000 words, you know, anyway. One of my favorite graphs is how much of total taxation used to be corporate taxation. And the OECD average, going back to the 1970s, was 20%. How much is it now? 2%. Now, if corporates have reduced their taxes by that much, and people are getting older and they want more health care, then where the hell's the money coming from? It's from us. So yeah, there are really sensible ways of doing this. It's called people who get property rights protection, et cetera, should pay for it. My favorite American example of this was when Mitt Romney was running for president. So Mitt Romney, because he runs a PE fund, pays capital gains at 15%. His real effective tax rate, because he's able to take advantages of certain loopholes, advantages in corporations and other things, is less than 10%. I pay 31%. So does everybody else. So when you have a system that's set up to reward the people who can pay more to pay less, while insisting that those who have the least pay more, hence the complaint that 47 million Americans don't pay any taxes. Yes, because they don't earn any money. It's really simple. Sort that out, and then the rest of it takes care of itself. You don't need a grand social experiment. Just pay your taxes.
Given our remaining time, is there any questions from the floor? There's a roving microphone.
Gentleman over here. Have you got a booming voice, sir, or do you need a microphone?
Yeah, I've got a good voice.
Here it goes. They're going to give you a mic anyway.
The probably biggest risk in the economy of the world is China. What's your opinion about China having a hiccup in the next 5 years and we all go?
Yeah. So, you know, I try and actually maintain the rule of not talking about stuff you don't understand or know. And for me, that's called China. Right? And I don't think I'm alone in this. Bill Gross from PIMCO had a wonderful line a couple of years ago where he called investing in China faith-based investing. I mean, it is a brilliant line, you have to admit, right? I mean, you don't trust the GDP figures, you have no idea what the banking system looks like, you're going to chuck your capital in there, good luck with it, and I hope Jesus is with you. Now, but at the same time, they keep growing, right? Now, here's the thing. Here's how I think we get confused about this sometimes, right? So let's think about the Chinese banking system. Now, the way that I try and explain this one to students is I put a slide up, don't want no graph, and it's a slide of Pudong. And if you look at Pudong of the Shanghai Financial Center, and it's got all this 23rd century architecture and all these big buildings and stuff, looks very fancy. And I point out that until very recently, there were only 2 Chinese banks on that whole island. All the rest of them were foreign banks. Very interesting. Why would that be? Well, one of those banks is essentially the check cashing agency for the Treasury that pays the state-owned enterprises wages. And the other one is the one that works with the foreign banks to essentially sterilize dollars so that they can insulate the economy. So that was how the financial sector works in that regard. But what about the domestic banking sector? Well, the only way we would make sense is that we called it shadow banks, right? Well, nobody has any idea what that actually means. Paul McCulley named the term, and non-deposit taking financial intermediaries that, yeah, right, whatever you want, right? So basically, they have a giant messy system we'd barely understand. It's probably bust. Here's the thing. They're communists, or at least authoritarians. The notion that this is going to be anything like a Western country when it has a banking crisis, the resolution authority will come in, there'll be an accounting of assets, we'll put this on this one, we'll create a bad bank and we'll put the bad assets in the bad bank and the good assets in the new bank, and then we'll add some punitive liquidity and we'll punish them with rates. And bullshit, none of that's going to happen. This will be dealt with. Quite how it will be dealt with, I lack the expertise to know, but it will be dealt with. Now, does that mean fragility or resilience? I think it actually means resilience. I really do. Where I worry about fragility with China is when they work cross purposes with themselves. So a good example of this is the whole notion of the Spartleys and the Scarborough Shoals and all these places that none of us had heard of 5 years ago, right? So here's the deal. China doesn't want to actually buy any more US debt. Fair enough. Knock yourself out. In fact, they've been getting rid of some of it. Knock yourself out. What they want to do is they want to buy real stuff. But the United States has a thing called the Foreign Investment National Security Act of 2007, and they don't like selling real stuff to China. Turns out, neither do you lot. And actually, turns out, neither do the Brits. Bit racist, really, isn't it? But there you go, we call it national security. Now, eventually it just becomes stand-up, right? I mean, this is the whole thing, right? But anyway, the serious point is, they can't buy any real assets. We won't sell them to them. So what do they want to do? They're going to build them. So this is this one belt, one road policy. Now, this is actually kind of brilliant, right? You can build infrastructure like nobody can build infrastructure. You've got this idea that you can basically build out all the way to Pakistan, down to the Gulf, all the way to Indonesia, back up, and you get to own it all, but everybody else gets to use it. And you get to build. This is so much better than holding another bit of American paper yielding crap, right? I mean, this is fantastic. But then you build a navy, and that navy builds an island. And then you basically annoy the crap out of all the people and scare them half to death that you want to build the infrastructure for. That's not very clever, is it? And it's that I worry about more than anything else. I talk to the US Navy twice a year, mainly because they don't want me 3 times. But I go down to the Pentagon to talk to them. And I've been doing this for a number of years. And if you went 5 years ago, they were really worried about China. They were really worried about China in the sense that they're taking over, etc., right? Now they're not. They're worried about a war with China, but happening for the wrong reasons. Specifically, this whole thing begins to get out of control. That's what keeps them up at night, worrying about that. So it's this disjuncture between financial policy, domestic governance, the crackdown and corruption, and then the military expansion. That's where it becomes a bit more. In terms of the banking system, forget about it. Anyone else?
Yeah, I've got a question up here.
Where are you? I can't see you.
You look the other way.
Well,
Yeah.
There. Oh, hello.
Given the unpopularity of Trump and Clinton, is there any possibility at all of someone like Gary Johnson coming through up the middle and taking the presidency?
No. That's the American political system is designed specifically to avoid that. I mean, what people forget about is it's not the popular vote that matters. It's this weird thing called the Electoral College. And it's the number of Electoral College votes that you get. And that infrastructure is completely tied up by both the mainstream parties. Now, then add in the fact of how much money you would need to raise in such a short period of time to even be vaguely competitive in media terms against these guys. It's a big, big problem. So one of the interesting things about Trump is he's done so well without actually having to spend all that much money. We'll see how that plays out. But it's going to be very difficult for anybody else to come in, and that's by constitutional design. They just don't like it that way. If you got rid of the Electoral College and really made it just the popular vote, it'd be a lot easier, but that's never going to happen because it suits the people who have it.